$2 trillion. SpaceX's market cap as of June 16, 2026, after passing Amazon. SpaceX's annual revenue per their S1 filing, $14 billion. Amazon's revenue, $645 billion. That means SpaceX trades at approximately 140 times revenue. Amazon trades at 3 times. The Musk premium is 45x. Watch until the end. I'll show you the single financial metric that tells you whether SpaceX is the next Apple or the next Tesla circa 2020. The headline number. SpaceX trades at approximately 140 times annual revenue per June 16 pricing. Amazon, the company SpaceX just passed in market cap, trades at 3 times revenue. Apple trades at 8 times. Tesla at peak in 2021 traded at 22 times. SpaceX is currently the most expensive large cap stock by revenue multiple in the public market. The question every investor needs to answer is the future revenue ramp real enough to justify the multiple? Or is this a Musk premium that gets repriced when the next quarter disappoints? Tesla in 2020 traded at a similar premium. Same Musk vision narrative. Same 1 trillion revenue target by 2030. Same retail investor enthusiasm. From 2020 peak to 2022 trough, Tesla fell 73% as the revenue growth slowed below expectations. Investors who bought Tesla on the vision narrative at 2020 peak waited 4 years to break even. Jim Cramer's June 16 comment summarized it. Quote, investors aren't buying earnings, they're buying Elon. That framing applies to SpaceX today exactly as it applied to Tesla then. Here's what's different about SpaceX versus Tesla in 2020. Starlink revenue is operational and accelerating. Per the S1 filing, Starlink generated $9 billion of the $14 billion total revenue. Subscriber count over 7 million, growing approximately 15% per quarter. Cash flow positive since late 2024. That's a real recurring revenue business that can grow into the valuation over time if execution holds. The launch business adds another $4 billion with industry-leading margins. The vision narrative is partially backed by a working business. Whether the growth rate justifies 140 times revenue is the open question. Options on SpaceX started trading after the IPO. Per the June 16 options data, strategists are calling the volatility surface, quote, dangerous. Implied volatility on at-the-money options is over 100% annualized. That means the market expects the stock to move plus or minus 50% in the next year. Put-call ratios are skewed toward downside protection at strikes 30% below current price. Sophisticated investors are hedging aggressively even while they hold the stock. The options market is pricing significant downside risk even as the spot price sits at all-time highs. Here's the signal I promised. Most investors will watch SpaceX revenue total. Wrong metric, it's already in the price. The actual metric that defines whether SpaceX justifies 140 times revenue is Starlink quarterly net subscriber adds. The current growth rate is approximately 15% per quarter. SpaceX needs to maintain or accelerate that for at least 8 quarters to grow into the current multiple. If Q2 reports below 13% growth, the deceleration narrative takes over and the Musk premium compresses. If Q2 beats 15%, the bull case holds. Q2 earnings drop in August 2026. That single line item defines the next year of SPCX trading. August 2026. Q2 SpaceX earnings. Starlink subscriber growth is the line item that retroactively defines whether the Musk premium is justified or whether SPCX repeats the Tesla 2022 re-rate. Most investors will watch revenue. You now know the actual metric. Subscribe to tickr for the breakdown when Q2 drops. Next week, we walk through Fox Roku and what $22 billion actually buys in the streaming wars.